Yo, what's up guys? Today's video is pretty basic. It's just how I pick my options. I don't have a live trade for today because I didn't take really anything that was good. So yeah, just going with this, trying to fill out the education playlist as much as I can. So pretty much when you want to pick an option, what I do, usually do the closest expiration. That is a little bit riskier sometimes, like especially on a Friday, but it does have the best reward. And on a Friday, I usually just size down since contracts are going to be more volatile. You can just play next week's expirations and keep the same size if you want. Either way is going to work, but if you're playing on a Friday, I definitely recommend sizing down just because the volatility is a lot higher if you stop out. You might not get that 5% stop that you're looking for. You might get a 10-15% stop on the same price fluctuation. So just as an example, a play that we were looking at today was Shopify 65 break. You could have got in at this high of day level at 64.70 ish. So let's say you did want to play this and you're looking for an option. You just come to this all products tab, shop. So since we're looking at upside, you want to play calls. Calls are for upside plays, and then puts are for downside plays. So the level I was looking at was 65. Since that's a whole number and it's like 60, 65, 70, 75, those are usually going to have the most liquidity. So that's going to be pretty easy to pick your option. You can see volume on the 65 calls is the highest out of everything really. So yeah, I would just pick the 65 calls just based off that. Plus, when you're getting, let's say you got in at this 64.70, when you get from out of the money to in the money, your contracts are going to have an extra premium flip. So if you can get the right out of the money to flip it in the money, those would be the best options to get, as long as the volume and open interest is high enough and the spread is tight enough. So that's an easier example just because like you can see this volume and open interest is pretty high. I'll show you something that's probably not going to be the easiest to pick. All right, let's say you open BA and you liked I don't know, let's just say you liked it right off the open downside. So it opened at 203 and then it dropped all the way down here. So let's just open BA. So if you're playing downside, by what I just said, let's say you look at the closest to the money. So it opened at 203. So the closest puts at the money would be these 202.50s. But now look at the volume, and this is also, it's 130 right now, so the volume has established itself a lot by now. Off open, this was probably single digits, maybe 10, 20 contracts. When volume is that low, you either want to look at the next out of the money or maybe even in the money. Since these next out of the monies are 200, which is a big whole number, a big psychological number, those usually have a lot of volume and open interest, and it looks like the spread on those is good. So even if I was playing this 203 level to the downside, I would still pick these 200 puts even though they're a little farther out of the money and they're not going to have the premium flip, just because the spread is tighter and there's a lot more volume. So you're going to be easier to fill and you're not going to fill red a lot. See, like here the spread is $15, which is it's not horrible for BA, but it's not the best either. This spread is a lot tighter. It's still not the best, but it's a lot tighter. So I would do something like that. Picking options, it's pretty simple. Let's go to something like SPY. It's going to be a different story for here. Let's see, SPY. Okay. So SPY, let's just stick with the downside. Let's say you're playing downside, this low of day. It's at 413.82. So something about SPY is that they have contracts that expire every day. Today's the 10th, yeah. So since they have every day expiring contract, you see May 10th, May 11th, 12th, 15 is Monday. Yeah, that's Friday. So yeah, since they have expirations every day, these contracts are going to be more volatile if you do today's expiration. So what you can do is either pick tomorrow's expiration, which is going to be a little safer, also a little bit more expensive, or you can do in the money. So yeah, I was looking at this 413.70, just hypothetically I was looking at 413.75. So what you could do is play the 414 puts. So SPY, you can do pretty much any strike. They all have, look at this volume, hundreds of thousands for like all of these strikes. And look at the spread, super tight. It's $1 off. So pretty much any strike price is going to work, but you want to do either right at the money, one out of the money, or one in the money. Anything past that, I wouldn't even say it's worth it. So a play like this, I would probably do the 414 puts just to be safe. You can do the 413s. The only difference is that the 414s, if you get stopped out, it's not going to be as big of a hit as the 413s. So pretty much think about it like, since these contracts are expiring today, if it doesn't, like let's say if SPY closes the day at 415, all these contracts below, the puts, the 414 puts, 413s, 411s, 412s, those all have to expire at 0 because they're worth nothing. A put is the right to sell a stock at this price. So if the stock is at a higher price, why would you agree to sell it at a lower price? So that's why these out of the money strikes on same day expirations are a lot riskier. They do have more of a reward if it does go in your favor. Like if you did play 413s, you might have caught 30% versus the 414s might have been 23%, just for example. So out of the money is going to be higher risk, higher reward. But for SPY, same day expirations, you might as well go the safer route. You're still going to get a lot of reward, more than any other stock, catching a move like this. So I would just protect your downside, because your upside, if it does work, regardless, is going to be really good. But SPY, just like how I said other stocks on Fridays you want to size down, I would recommend sizing down for SPY, especially if you're playing same days. If you're playing next days, you have a little bit of wiggle room. But if you're playing same days, contracts could take a big hit if they go against you. So I like to size down on SPY. QQQ is the same thing as SPY. It's just for the NASDAQ instead of the S&P. But yeah, this should be a pretty simple video. So pretty much the main things I look at are volume, open interest. So if I'm doing something right off open, I'm looking at open interest. Here's probably a good example. Airbnb, because they had earnings. I have no idea what they did today. Okay, they went up. So Airbnb. You see how the volume is kind of all over the place? How this 115 has a much bigger, volume than the rest of the strikes. That's just because this is one of those key psychological levels. Yeah, even the 115 puts, you see the 110 puts have a lot, 115s, 120s. You see how it is? So yeah, if you can play these psychological levels, that's good. But if the spread is tight enough and there's enough volume, then you can play these, at the money or right out of the money strikes. You don't want to go too far out, especially if the at the monies or just out of the monies are sufficient in volume and with a tight enough spread. Just because if you do go out of the money too far out, you're just risking a lot, and you might not even get paid more than if you played right out of the money. So the risk is higher with not that much of a reward. If you catch a crazy move, I'm sure, yeah, it'll go in your favor. But, that's not what you're looking for as a scalper. But that's pretty much it. Should be a simple video. This is just how I pick my options. And then after I pick my options, I have a watch list here. And I link this watch list, you see number 2, to my active trader. So right now I have this shop open. Like, let's say I wanted to switch over to Netflix, it goes Netflix, or Nvidia, boom, Nvidia, SPY. So yeah, it just makes it easier to switch in and out of your options. Let's say on your side screen you see something setting up, you want to switch quick, so you just go boom, Netflix, boom. So all right, right here is an example. I have 2 Netflix calls open. The best way to see what call to play is pretty much just what I said. So I mean, these are super far out now. Netflix probably died. Let's see what happened. Yeah, okay. So let's say you're looking at I don't even know. Oh, here, 336.32. So yeah, right around here, which it looks like it wouldn't have worked, but okay, that's good. Good I didn't take it, not good it didn't work. So I had the 337.50s because that was right out of the money, and then also the 340s. So let's see, volume on the 340s is a lot higher, so is open interest. The spread on both are pretty good, but also the volume on these are good enough with a good enough spread. So either one would have been valid. Seeing this, I probably would have played closer to the money just to get that premium flip if I did play it. But yeah, that's pretty much the video. Should be simple. Don't overcomplicate things. Just some tips on how I pick my options. Peace.